G'day traders, Stacey Burke again from Stacey Burke Trading. If you don't mind just taking one moment and hitting that like button for me, drop a comment, let me know where you're trading from in the world, whereabouts you're located. And if you want to share this video, feel free, I'd appreciate it. If you know somebody that might benefit from it, hit the subscribe button so that you get notifications of when we release a new video. And again, thanks for following. Let's get started. G'day traders, Stacey Burke from Stacey Burke Trading. Today doing a video on second day trades after a news catalyst. One of the things I look for, especially with gold, you won't see this in most of the major pairs, but in gold this tends to show up frequently with the Fed. The day after we see a follow-through trend trade after the large move, and just covering last night's move in the Fed. Obviously, for me being in Perth, West Australia, I'm in bed and I don't typically trade that, and you'll see the same behavior over and over again. They typically will spike both sides before moving the market in one direction and then locking it in sideways, whether that be for a continuation of a trend day or in this case a reversal trade setup, as we see day one Monday, day one, day two, day three. And we get our stair-step pump and dump effect heading into the Fed, trapping traders at the beginning of the week down low at the low of the week, low of Thursday, Friday, before reversing with our W formation, our double bottom. And then typical with the Fed, they go up 50 pips above the range, 50 to 75 above the range, trapping traders on breakouts of the high of the day and the high of the week. And then reversing, obviously hitting stops, triggering breakout orders, and pulling back and closing into consolidation underneath of the daily range. So again, heading into this market, I look and I say to myself, there's a death line. We're closing underneath of that entire Tuesday, Wednesday range. But also, as we zoom in, we can see a couple things that we discussed earlier this week with our pump and dump. And one of the things I look for in the close of the U.S. session or from the U.S. session, again, we talked about this, is looking where I can find evidence of where a trade setup began heading into the end of the U.S. session or into the close. We saw this on Tuesday, the push up, and then the three levels of drop back into that trade for the explosive 50 pip move back up. Then we saw the three pushes in up from Asia, two pushes into the high, and the 50 pip stop hunt, the creeper down into the low of the day. Obviously then a squeeze and a stop hunt back up inside on traders that were short before the vertical spike to the low, spike to the high, and then the trend move all the way back down. Now, one of the things that I look at is, do I have evidence of that heading into today's session for a second day trade? We see the bull pin off the bottom and then the pullback. And after we see a violent move like this, all I do is I redraw my highs and my lows. And I have a saying, you've heard me say it before, don't counter trend the peak formation. So our peak formation is up. We have a peak formation high. So if this was our pump, again, we can see the follow through. But I see the market trading into our second push up, just above 75. We're underneath double zeros. In our first hour, again, first hour trade, first bar trade, this is something I look for, is, are we going to break that first hour just heading into our session? So obviously our best entry may be in this peak formation, obviously in where this reversal took place inside of the peak, if I'm shorting this. But I like to wait towards the end of that second hour heading into the open of the session, knowing that this market is going to give me an indication that that is going to follow through. Now we have the higher level longs following this up. So we got traders trapped above 75. Again, an optimal entry for me would be to get filled at the numbers plus the spread at a minimum. But when I zoom in on my smaller time frame on the 1 minute chart, we can find our pumping bull candle starting off of 50 after the Fed is started doing consolidation. Over an hour later, we see our first burst, our second burst, or second burst to the high before they come back. So one push, two push, three pushes, locking in the high. They come back down below double zeros. So heading into the new day, we have our lower high below double zeros. just project that across, and again, the thesis being, if this is going to give me a second day trade, this reversal where the pump began is going to fail. Now, as we head into the new day, again, we draw our consolidation. We just looking at our highs and lows. And the day starts off very similar. We start a pumping action as soon as the day begins. We'll just zoom in on this here once we shorten our screen. And again, we have a lower high, trading back up into the high, a follow through that fails to follow through, and then we start to see the weakness begin. Now, when we break through in that lower quarter, we're still half an hour outside of the session beginning for me in that first hour, but we're also still above where that pump began. Now, this is what I look for, the market to get traders chasing this in early. They chase this in early, and what you'll see at the beginning of the session is this move back up aggressively, back up towards the high, and obviously we have our creeping trend and engulfment and our M structure locking in 75 prior to the session beginning. So when this market pulls back up, I'm fighting for the best fill price I can, and anywhere inside of this rectangle on a bull candle, if I can't get filled at the numbers, I'm looking to get filled as best possible before this market runs away. I've already got confirmation that they've locked in 75. Our peak formations have broken through. We have a rectangle up top, so we have our pattern within a pattern. We'll get rid of these other lines. You can see the market dropping down, making another rectangle before finally breaking through. So when I'm in a situation like this, number one, I'm watching the clock because I'm in my head. If I'm not getting filled up at 77, 76, I want to at least get filled at 73 or better. So I'm getting in this market, at which point I got filled at 74.5. And understanding that this market, now that it's in consolidation and we've already broken down, we're already in a breakdown consolidation, this market could be in a fast moving market about to move very quickly. Now, coming back to our 15-minute time frame, when we look at the levels that are in place, we have our higher level short and then of course the low of the day, and that market again following through. Just looking back at Monday night, we had consolidation at the previous day's high. The market's already cleared that out, and below that we have buyers all the way down to the break in the London session. So again, we know there's traders down there in the money. We have a lot of follow through. We have a dump and pump situation happening, dump. So even though we're down low, the same scenario happens. I'm looking for a second day trade setup to enter in and expecting a fast, aggressive move. Now, again, this is not a move I'm holding on to. I'm just looking for my 50 pips, and as that market's blowing off, going back to our 1 minute, as the second hour opens and it goes vertical, I don't have any hesitation on just getting out of that trade, especially if I start to see evidence of 1 push, 2 push, and then 1, 2, 3 into the low. Now, I have no desire to counter trend this because, again, if this is our first red day after a day 1, day 2, day 3, and I have volume trapped up high, we have a death line, double zeros. This may be a trend day. It may not be. It may be a consolidation day. This may be the high-low for the entire day, 75 pips. So again, understanding 3 levels of drop. So this was a fantastic trade. We'll look at some previous examples. When we look at July 28th, the most previous one, we see the same scenario. The market follows through the end of the day, and we get a second day trade continuation in Asia as well as the rest of the day. This was the Fed back in July. Same situation. Large move. The market has an opportunity to digest that move and continue it. But we also had volume trapped again underneath after the news. And the scenario that I paint in my head is that these are people who have potentially sold down low. They're caught, and this market will now move aggressively away. June 16th, we see a similar explosive move, and then a fairly large pullback before continuing, but understanding that, again, the same scenario applies with the pump and dump on that occasion. The market did not have any consolidation at the close. The pump begins at the end. You'll notice a bull pin. We'll zoom in a bit on this. a bullpen. I can get rid of my numbers here just to make that clear for traders. As our Asian session begins, the pump starts. They pump it up, make a lower high. They pump it up, take out that lower high. That market then follows through and makes a micro M structure up high before breaking out of that upper rectangle, dropping down, taking out the higher level longs, and pulling back, engulfing, and then following through. Now this pattern, again, it is an example of taking a measured move target, one full range expansion as a minimum of a profit target. So again, this was the Fed in June. April 28th, we see the Fed again explode long, and the next day follow through into our Asian session, continuing for almost another 100 pips from the open of the day, but obviously 50 in Asia. Again, a strong follow through and an example of where Asia put in the high of the day. So again, taking that profit target, we're approaching the double zeros towards the end of the session. We've had an hour and a half of rise plus. Again, not getting greedy, just taking the trade. And again, just focusing on the second day catalyst opportunity follow through if the trade opportunity presents. Looking in March, we see the violent explosion, the creeper back down, but into the close and the consolidation, we see the bullpen again, explosive boom, one pump, two pumps into the open of Asia, three pumps for a 50 pip move from 0 to 50, again before they lock in the high. So obviously, again, as I said, not every instrument's going to move like this, but gold seems to have that second day follow through after the Fed for a second day trade after a news catalyst for a strong 50 pip move. And so again, just an example of adding a trade setup into your playbook. If you're in North America, I know some people like to trade the Fed after it's released, but this is a great example of what to look for with pairs that respect this. Obviously, you can go back and test it, but with gold, it seems to be an ideal situation. And again, think about the psychology behind that. And some of these moves that have failed after the Asian high, they've also trapped traders breaking the previous day's high. And they've got them caught up high now before possibly reversing. And so the importance, again, of learning to take a profit, locking it in, knowing when that trade may be reaching its expiry based on price action, major round number levels, time in the market, all of that sort of situation. We'll look at one more. So this is a good example where we see the Fed come back after a peak formation low. One push, two push, three pushes into the close, stop hunting down on the higher level longs before breaking back and forming a lower high at the beginning of the session. And then we get our push into double zeros and a 50 pip move down into the open of the Asian session. So again, high and low, we see a M pattern formation right in the rollover. After we've had the higher level longs hit the stops, they go up and hit the stops on traders that are short. Give a middle structure and take it back up to double zeros sideways into the open for a 50 pip 45-minute move. Stop hunt back down into traders that were long into the close. So again, it may not necessarily be just a second day continuation with the trend. This is an example of peak formation low where they worked it back up into a high. They formed a high of the session and then stop hunted back down into the long traders that were long. But a second day trade catalyst, gold seems to offer that opportunity. Again, as I mentioned, it's in my playbook. I'm just going to look for these setups as I do in Asia on gold. And, after you have a big move like that, it's bound to see a second day opportunity. So hopefully you got some value from today's video, traders. Again, keep it simple. Stick to your best trade setups. If you're not sure what they are, step back and start looking at some of these patterns. Don't trade them. Just watch and learn. But if you've got them in your playbook, and instead of just trying to focus on trading one instrument all the time, look for the setups and maybe have 3 or 4 instruments that each session you look for one best setup based on your playbook to trade that opportunity, whether that be the U.S. session, the Asian session, or maybe even the London session. So keep it simple. Have a great trading session. Again, thanks for a ton of great comments and feedback. Keep getting better, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.